Hi guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. Crypto traders love to ape and make gain investment using high leverage in future market, but most traders fall victim to these 3K mistakes. Airdrop can also cause discounts future price since the holders of derivative contract will not receive the award. But that's not the only case behind a decoupling, since each exchange has its own pricing mechanism and risk. For example, Polkadot quarterly future on Binance on OKX have been trading at a discount versus GOT price on spot exchange. Many traders frequently express some relative large misconception about trading cryptocurrency future, especially on derivative exchange. Outside the realm of traditional finance, the most common mistakes involve future market price decoupling, fees, and the impact of liquidation on the derivative instrument. Let's explore three sample mistakes and misconceptions that traders should avoid when trading crypto future. Derivative contract differ from spot trading in pricing and trading currently. The aggregate future open interest in the crypto market surpassed $25 billion, and retail traders and experienced fund managers use this instrument to leverage their crypto position. Future contracts and other derivatives are often used to reduce risk or increase exposure and are not really meant to be used for degraded gambling. Despite this common interpretation, some differences in pricing and trading are usually missed in crypto derivative contracts. For this reason, traders should at least consider this difference when venturing into future market. Even well-versed derivative investors from traditional assets are prone to making mistakes, so it's important to understand the existing peculiarities before using leverage. Most crypto trading services do not use US dollar, even if they display USD quotes. This is a big untold secret and one of the pitfalls that derivative traders face that cause additional risk and distortion when trading and analyzing future market. The pressing issue is the lack of transparency, so clients don't really know if their contract are priced in stablecoin. However, this should not be a major concern, considering there is always the intermediary risk when using centralized exchange. Discounts futures sometimes come with surprise. On September, other ETH futures that mature on December are trading for $22 or 1% below the current price at spot exchanges like Coinbase and Kraken. The difference emerges from the expectation of merge fork coins that could arise during the aftermath. Buyer of the derivative contract will not be awarded any of the potentially free coins that either holders may receive. Notice how the future contract trade at a 5% until 6% discount between 2021 and 2022. This backwardation demonstrates a lack of demand from leverage buyers. However, considering the long-lasting trend and the fact that Polkadot trailed 40% from July to August, external factors are likely in play. The future contract price has decoupled from spot exchange, so traders must adjust their targets and entry level whenever using quarterly markets. Higher fees and price decoupling should be considered. The core benefit of future contracts is leverage or the ability to trade amounts that are large than the initial deposit. Let's consider a scenario where an investor deposits worth of Bitcoin or BTC future using leverage. Even though the trading fees on derivative contracts are usually smaller than spot market, a hypothetical fee applies to the entering and exiting the position a single time will cost, which is equivalent to 4% of the initial deposit. Okay, maybe that's all from me. Don't forget to like, comment, share, and subscribe.